Hello, this is Ron Henderson, the Government Affairs Co-Chair for the California Association of Mortgage Professionals. It's November 6, 2017, and the Proposed Tax Cuts and Jobs Act, HR1, was just released. You're going to be hearing a lot of pushback on elements of the legislation, and for good reasons. I'm going to go over several aspects of the bill and its direct impact on real estate and mortgages. Some have hit the media, some haven't. One thing that you have to keep in mind that the general population or our representatives may overlook is home ownership has been historically the main driver of building wealth at all economic levels. If you're only looking at how the reform affects your paycheck this week or your tax returns this year, then you're missing out on the big picture. You're not going to help grow the middle class, and you're eliminating a key area of retirement savings. Let's start with the owner-occupied capital gains exemption, Section 121. The $250K and the $500K amounts haven't changed, but the timeline has. What is presently owner-occupied 2 out of 5 years, and you can use the exemption every 2 years, would be modified to be occupied 5 out of 8 years, and you can only use the exemption every 5 years. There's also a dollar-for-dollar phase-out of the exemption. If, as an individual, if you make $250,000, or as a couple, $500,000 in the applicable tax year and the 2 prior years, then it's phased out. This would be applicable to sales starting December 31, 2017. 1031 exchanges. It appears that they're not looking to change the primary elements applicable to real estate, but they would be striking the word property in the code and exchanging it with real property. In other words, livestock, equipment, vehicles, those types of items would not be applicable to an exchange. And it also is not applicable to any properties that are being held primarily for sale. This again would be applicable to any transaction at the end of the year. State and local taxes would no longer be a write-off, but they did do a carve-out for up to $10,000 for property tax. Now in Los Angeles County, that would be applicable to approximately an $800,000 assessed value. Mortgage interest deduction. Number 1, the taxpayer will be limited to 1 qualified residence, no more second homes. The limit for the loan principal amount in which the interest can be deducted drops from $1 million down to $500K. Mortgage debt that was acquired prior to November 2nd, 2017 will be grandfathered into the old code, so you'll still have up to the $1 million amount. Any refinancing of that debt will be treated under the new parameters. Refinance loans would be limited to the amount of the original debt. So cash out amounts, unless it's utilized to substantially improve the residence, can't be written off. Also, the refi will be treated as if it was incurred on the same date as the original debt, so you're not extending the write-off period. Any new residents under contract prior to November 2nd of this year, that debt can be treated as if it was incurred prior to November 2nd. New equity lines can't be written off. Another thing to keep in mind, if you think the $500,000 and $800,000 parameters are high and doesn't affect you today, it wasn't that long ago that a Los Angeles home was $200,000. With basic inflation, these amounts become more restrictive. The government is essentially eliminating real estate write-offs over time, and geographically penalizes those in high-cost regions. The government's trying to sell the idea that everyone's taxes will go down, mainly because the standard deductions and child tax credits will be going up. In reality, disincentivizing homeownership and making it more expensive is counterproductive to individuals and local economies. There are several unintended consequences involved in this specific restructuring of the tax code. CAMP will be sending out call to actions. Again, this is a proposal, not a law yet. If you don't like it, tell your representatives. Till next time, take care.